This is a lab for break-even costing. We'll start by reviewing simpler calculations and then advance from there. Here's the data for the first lab problem. As with all my labs, I recommend you format the spreadsheet to currency without the dollar signs. I also usually say to have 0 decimal places, but since variable costs sometimes have cents, feel free to set it to 0 or 2 decimal places. Later on, you'll have to move certain things to 2 decimal places. You may notice that I prefer to set up problems vertically. Experience has taught me to put the data first and put the problems vertically under it. Because we're working with break-even, we'll use the contribution margin income statement. For our problem, this company sells balls for $25 a piece, and the financial statement information shown here is based on the sales for 64,000 balls. For the total sales, use referencing to the cells above and compute the sales as the number of units times the sales price. And make sure you set things up using both the contribution margin formula of sales minus variable costs and the net operating income formula of contribution margin less fixed expenses. Do that instead of simply typing the numbers you have. This will save you trouble when you want to adjust the initial data. This information is for later in the problem. Since it makes sense to keep all the initial data together, please put it directly under the problem data. That way it will be easier to find when we need it later. There are several things we will do with the data, but we're going to start simple. The first thing we will do is called Part A, or compute the contribution margin ratio, the break-even point in units, and the degree of operating leverage for last year. You can see that I hid those rows of extra information. That was just to make showing the formulas in the cells easier. The contribution margin ratio is simply the contribution margin divided by the sales price. It is my cell B13 divided by my cell B11. After you've done that, don't forget to change the formatting to a percentage. For the next part, we need to find the break-even in units. While the normal formula is to have the fixed cost divided by the contribution margin, this time we'll have to do a little work first. Don't ever forget that you don't have to use only the information given. You should be able to do a little algebra so the information can be moved to the formulas you need. So, we were given the total variable expenses, but if we're going to calculate break-even per unit, we need the variable costs per unit. Since you were given the variable expenses for 64,000 units, divide the variable costs that you were given by 64,000 units to find the variable expense of $15 per unit. You may notice that I didn't put the contribution margin here, but you can if you wish. However, I did put it in the formula, so the break-even in units is the fixed expenses divided by the contribution margin of sales price less variable costs. Make sure to mark the variable expense as currency, but don't do it for the break-even in units. Then, part 3 is calculating the operating leverage. We know the formula is the contribution margin divided by the net operating income. Because the amount is small, remember to make the degree of operating leverage to 2 decimals. For part B, we'll use some of that initial data that was given earlier with the problem. If the company keeps everything else the same, but estimates that next year's variable expenses will increase by $3 per ball, what is the break-even in units? We're going to come back to the next parts in a minute. That information is an estimate that the variable cost will decrease by 40%, but the fixed cost will increase by 40% if a new plant was built. But we're first going to start with just the estimated change in variable costs. We first need to calculate the new contribution margin. So if the variable cost was $15 and it increased $3, the new variable cost is $18. And since the contribution margin is sales of $25 less the new variable cost of $18, the new contribution margin is $7 per unit. The contribution margin ratio is the contribution margin divided by the sales, or $7 per unit, divided by $25 per unit sales, and the new contribution margin ratio is now 28%. Part 2 is calculate the new break-even number of units. That's simply the fixed cost from earlier, so reference the cell with the $427,000. For me, it was cell B14, and divide it by the new contribution margin of 7. You should get 61,000 units. In Part C, we work the number of units to arrive at a profit. You know the formula is fixed cost plus target income, all divided by the contribution margin. But what happens after tax? This is something people don't think about and often make a mistake calculating it. I don't want to mention the most common mistake because I don't want you to think about it and then remember it as what to do later. But if you take a breath and think about what you know, you can solve it on a test. Set up a formula with what you know and then do the algebra. We know we want a required net income, so it makes sense to treat it the same way as a fixed cost. So the number of units needed for the net income is no longer called break-even units because we're doing more than break-even. But the formula is the fixed cost plus the desired amount, all divided by the contribution margin. Now, what if the target net income is after tax? Well, the income after tax is the income less the tax. So let's call that target income TI. We also know that if taxes are 20%, we take home 1 less the tax rate, 1 less 20%, or 80%. So our income after tax is 80% of our TI. So we have to find out what is our TI. So remember this little piece of algebra. Now, I'm not going to use the word net income because that comes after taxes and everything else. So I am going to use the word target income, or TI. If the tax rate is 20%, then 80% is what we take home. So 80% times the target income gives us the income after tax. Doing some algebra says target income, or TI, is equal to the income after tax divided by 1 minus the tax rate. In our case, it is the income after tax divided by 80%, which is what we're going to take home after tax. So we use income after tax divided by 1 less the tax rate as target income and plug it back into our computation to find units to achieve the target income after tax. Knowing that information, we can do Part C. C is the unit sales for the desired profit without regard to tax. Then we will deal with the after-tax algebra as on the last slide. And we'll find the unit sales for the desired profit after tax is 99,036 units. Part D is a twist on the information provided, but that's only because your focus is being changed. So you need to pay attention to what is changing and what isn't. For this problem, we go back to the revised variable cost. In this case, management wants to change the selling price and maintain the original contribution margin ratio. So before we can calculate what the increase in sales we need to find the new sales price. Well, we know the contribution margin ratio is 40%, and that's what it was with the original data. So the variable costs are 60% of the sales price. If 60% of the sales price is $18, then algebra says divide both sides by 0.6. And when we divide the left side of the equation, we're left with just sales. And when we divide 18 by 0.6, we have $30. So the new sales price has to be $30. Of course, we should be able to prove it. Being able to go back and forth and prove things show you understand what's going on. So if we have a new sales price of $30, variable costs of 18, the contribution margin must be $12. And we divide the 12 by the sales price, the contribution margin ratio is that 40%. Now in Part E, we're going to use even more of the estimated data given earlier. Here, the company is discussing a new automated manufacturing plant. This new plant would cut the variable expenses per unit by 40%. But since it's automated, the fixed costs are going to double. If the new plant is built, what would be the new break-even point and the new contribution margin ratio? This isn't tricky, but you do have to know where to take the formulas. It's also why it helps to use formulas instead of just typing in the numbers you see. The sales price is just a reference to the initial sales data. Since the variable costs will decrease 40%, the variable costs are 1 less that, or 60% of the original cost. So set a formula for variable cost just as the initial data times, in parentheses, 1 less the 40% that's shown in the cell above. That should give you the contribution margin of $16. Now, you also know that fixed cost doubled, so the estimated new fixed cost is the original fixed cost from your earlier cell times the 2 from the cell with the additional data. Now, you can finally calculate break even, and you should find that you need 53,375 units. In F, we're using the same information from E. If the new plant is built, how many units will have to be sold to have the same net operating income as the prior year? This is the same as what we did earlier, but with the new building's change in fixed and variable costs. In other words, the profit is from Part A, or the base problem, and the variable and fixed costs are from Part E. Compute the units for the desired profit of $213,000 given earlier. And remember, the fixed cost and the contribution margin have changed. So the number of units you now need is 66,688. Then for Part 2, use the original 64,000 units sold and prepare a contribution margin statement. This is why using referencing instead of just putting the numbers into your spreadsheet is helpful. You should be able to do this statement easily. Then, Part F3 is the degree of operating leverage. It's the contribution margin divided by the net operating income you just calculated. You should get 6.02 as your ratio. For G, we're going to switch to a new problem. This is just to work with some multi-product information. Here is the data for you to input. The company makes 2 products, and the sales commission is a variable cost based on the sales price marked SP. This is actually simple. You do vertical analysis with sales as 100%. Then you compare all expenses to sales. If you do it for the standard product, you just have to copy it for the deluxe products and the total. The point is to see that the combined contribution margin is weighted for the products. That number is used for the calculation of break-even in dollars. It is between the 33.96% for standard and the 24.88% for deluxe. But it isn't simply the midpoint between the two. It is weighted towards the standard, which has higher sales. And you see the fixed costs are taken from the total. And when you take the fixed cost and divide it by the weighted contribution margin, you see that you need $732,882 in sales to break even. That will automatically work out as long as the mix between the products stays the same. That's the end of the lab. Please let me know if you have any questions.